This is the Retirement Lifestyle Advocates radio program. I'm your host, Dennis Tubbergen. Glad you're listening in today. Joining me in segments 2 and 3 of today's program is returning guest Dr. A. Gary Schilling. Gary has been a longtime Forbes columnist for more than 40 years. He is a money manager. He is a very bright economist, and he also publishes the widely read newsletter Insight that is more like a magazine every month. I'm going to get Gary's take in segments 2 and 3 on if the U.S. economy is headed for recession. What does he view Fed policy being moving ahead, given that we are in an election cycle? And what's his forecast for stocks, commodities, real estate? And what does he think about all the non-payments going on as far as student loans are concerned? So I'll get Gary's take on all that in segments 2 and 3. You'll want to stay tuned for that. I'm also today, for the very first time, offering a special report on the program. This report is titled Tax-Free Retirement Income Strategies. If you aspire to a comfortable, stress-free retirement, I would strongly encourage you to request this free report. It's available free with no obligation. Just go to requestyourreport.com. Let me know your name and address, and I'll mail you the report. And again, there is no cost. There is no obligation. Just go to requestyourreport.com. We have a planning opportunity really for the next 18 months to potentially save a significant amount of money in taxes on your IRA and 401k. The report talks about some strategies for you to consider. So again, go to requestyourreport.com to get your copy of that report. Well, if you have been paying attention to the stock market, you know that we have the Dow Jones Industrial Average and we have the S&P 500, both at or near record highs as I am recording this week's program. The Dow Jones Industrial Average now over 40,000. The S&P 500 up over 5,500. Does this mean you should back up the truck and buy stocks because the rip-roaring bull market is back? Well, my opinion is you should proceed with caution. And in this segment, I want to talk to you a little bit about that. I have a newsletter titled Positions that is for subscribers only. And in the last issue, I shared with subscribers that this advance in stocks has occurred on lower trading volume. Now, what does that mean? Well, it just means that the stock price is going up, but participation in the market is going down. That is often a bearish divergence. A bearish divergence simply means it's a signal that often precedes stock declines. Now, another thing that I'm going to talk to Gary Schilling about today is the breadth in the stock market. Breadth also is another way to measure participation. And one way to measure market breadth is to take a look at the number of advancing stocks compared to the number of stocks that are declining. To put that another way, we take a look at how many stocks are going up in price versus the number of stocks that are going down in price. Now, this is a technical indicator that is known by technical analysts as the advanced decline line. Now, I mentioned at the outset of this segment that the S&P 500 is now at or near all-time highs. In fact, the S&P just this past week recorded its longest winning streak in nearly 6 months, and the price rise has been parabolic. A parabolic price rise simply means that the price of stocks has gone up, not quite vertically, but almost vertically. And I can tell you from past experience, I can tell you from 3 decades in this industry that parabolic price rises often end badly. Now, when you take a look at breadth as measured by this advanced decline line, the advanced decline line for the S&P 500 reached its highest level in early May. So that's about 2.5 months ago. So about 2.5 months ago, we had advancing stocks going up in price, exceeding declining stocks or stocks going down in price at the highest possible level. But for the past 2.5 months, we've seen fewer stocks advancing in price and more stocks declining in price. In fact, when you take a look at the number of stocks actually driving the market higher, there are 3 big technology stocks that are AI heavy that are actually making up about 20% of the market capitalization. Now, historically speaking, whenever you have this advanced decline line going up, whenever the number of advancing stocks exceeds the number of declining ones, while the market goes up, you have a confirmation signal. The market is moving higher. There are lots of stocks moving higher with the market, and that's confirming. However, when this advanced decline line starts to fall as the market goes up, you now have what could be a very troubling signal. And that's exactly what has been happening here for the past 2 months, 2.5 months. So this suggests that the index could be, doesn't have to be, but it could be nearing the end of its uptrend. So if you're investing in stocks, I would encourage you to think about having an exit strategy. What is an exit strategy? An exit strategy has you determining in advance under what circumstances you're going to continue to hold stocks and under what circumstances or conditions you'll think about selling stocks or lightening your stock allocation. Now, if we go back and look at what's happened historically, that doesn't necessarily mean it's going to happen again, but it can be instructive. When you go back to 1998 and look at the advanced decline line, the advanced decline line peaked in the spring of 1998, and it started to drop. And between July and October of that year, there was a 22% drawdown or a 22% decline in the price of stocks. Now, I find that timing to be quite interesting. The advanced decline line peaked in the spring of 1998. The advanced decline line peaked recently at the beginning of May. Very similar timing. It also brings to mind an old market adage that says you should sell in May and go away. So seasonally speaking here, we also have a bit of a negative bias in stocks. Now in 1998, from July to October, there was a 22% drawdown. Incidentally, something similar happened in the spring of 2007. Beginning in July of 2007, there was a decline that didn't bottom until March of 2009. So this advanced decline line, from an historical perspective anyway, can be quite valid. Now, that doesn't necessarily mean that we're going to see the same thing happen. However, you should be aware that the advanced decline line has declined since May. There is less participation in the market. There are fewer stocks making new highs, even as the index has soared to multiple record highs. Now, the other thing that is on my radar, we had Jerome Powell, the chair of the Fed, come out recently and talk, at least in a roundabout way, that they didn't want to be late cutting rates. So this seems that the Fed may be ready to begin rate cuts again soon. Will it happen the end of July? I don't know. Will it happen in September? I don't know. But they are talking about it openly. Now, the question, of course, is if the Fed cuts interest rates, will the stock market react as it has previously and rally? Well, if you call last week's program, I interviewed Michael Oliver. Michael is the founder of Momentum Structural Analysis. And Michael noted that more often than not, historically, as the Fed has cut interest rates, the stock market has declined. So given the lack of breadth in stocks, given that the advanced decline line is falling, given that there's seasonal bias, moving ahead, I would urge caution in stocks, particularly if you have money invested in stocks that you will need when you retire. Now, in the next segment, as I said, I'll be talking to Dr. A. Gary Schilling, publisher of Insight Newsletter. But before I go to the break and before we bring on Dr. Schilling, let me again remind you that the special report that is now available is titled Tax-Free Retirement Income Strategies. You can get that report by visiting requestyourreport.com. Just let me know where to mail the report, and I'll be very glad to do so. Again, the website, requestyourreport.com. I'll be back after these words with my special guest, Dr. A. Gary Schilling. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. Joining me on today's program is returning guest, Dr. A. Gary Schilling. You have undoubtedly heard of Dr. Schilling. He has been and was a Forbes columnist for decades. He publishes a widely read newsletter, Insight. It's published monthly. It's more of a magazine really than a newsletter. It's just a comprehensive look about what's going on in the economy and in the markets. If you'd like to learn more about that, you can give his office a call at 888-346-7444 or visit agaryschilling.com. And Dr. Schilling, welcome back to the program.
Glad to be back with you.
So, Gary, it seems that when you look at the latest unemployment numbers, it wasn't much of a tick up, but there seems to be panic amongst many prognosticators that this means recession is imminent. What's your take?
Well, that's been the case for the last couple of years. You certainly have indications of recession. Some of the leading indicators, which in the past have had perfect records, such as the inverted yield curve, with short-term Treasury yields above longer-term yields, and also the leading indicators index, which has been down now for many months. Both those indicators have always correctly forecast recessions, and they haven't had any false starts. So you kind of wonder when the recession is coming. Now, the reality is that the timing is always uncertain. You can have these indicators start to signal recessions a couple of months ahead, or it can be many months or years even ahead. So it isn't a lockstep kind of forecast, but it does tell you that you've got issues. And then you look at things like the speculation we have. You look what's going on with the Magnificent Seven stocks and NVIDIA. People have really gone hog wild on investment speculations, and that's very typical of the end of bull markets. So there are a lot of indications out there that say we should be looking at a recession and a bear market in stocks, but the timing is, as usual, uncertain.
Well, Gary, let's focus on stocks here for a minute because, you bring up an interesting topic. I think I read recently, correct me if I'm wrong, that I think it was Google, Apple, and NVIDIA make up about 20% of the market cap of the S&P 500. That's not much breadth, is it? I mean, has there ever been a time in history that has been the case to that extent?
Well, we've had similar periods like that. If you go back to the 1970s, you had the dot-com stocks, tremendous concentration of interest in relatively few stocks. You got to the point where the only thing that was interested to people were, gimmick cameras, Polaroid, motor homes, Winnebago, amusement parks, Disney, and and hamburgers. That was McDonald's. Those four companies were really the leaders. And I said back then, and still feel, that when you have that concentration on areas that are not really the guts of the economy, they're the limbs and outward flourishes, as Shakespeare said. And when you get that kind of concentration, it usually tells you that there's trouble.
So, Gary, what are you telling your Insight subscribers about stocks presently? Are you suggesting you steer clear of stocks? What's your forecast for stocks moving ahead?
Well, we're our investment strategy is really neutral on stocks. We're positive on the dollar. We're positive on Treasury bonds, and there are a few stocks. India, we've been very bullish on India for the last couple of years, but U.S. stocks, I think are just way too expensive to be justified, and investing in them, I think, is high risk at this point.
So, do you dare be so bold, Dr. Schilling, as to predict 30, 40, 50% decline? Or are you putting a number on what we might expect?
Well, that's always tough. I think in the past I've said I thought we could have a 20 or 30% decline in the overall stock market, and I still think that's possible. And of course, you have to be very cognizant that many parts of the stock market are actually weakened now. I would say that sort of the guts of the market, and the areas that have had the big run-ups are the tech stocks and the NVIDIAs and Microsofts and these and of course all the crypto stocks. These are the areas that I think have gotten out of hand and are the most vulnerable.
So, Gary, I read recently, doing a little bit of research, that the spread between the overall stock market and the overall commodities market hasn't been this wide in 50 years, and stocks are extremely overvalued, and relative to the value of stocks, commodities are extremely undervalued. Would you agree with that assessment?
Yeah, I think so. Of course, it's always a question, what's overvalued and what's undervalued. It's all relative. I mean, there's no absolute standard here, but certainly the spreads have opened up in a very unusual way, and I think unhealthy way. So I do think that there is a great risk here, as I say. And commodities are not necessarily cheap now, but relative to stocks, almost anything is cheap.
So, Gary, when we take a look at these indicators that we talked about at the outset, and I should mention for our listeners that may be just joining us, I'm chatting today with Dr. A. Gary Schilling. He is the publisher of the widely read newsletter Insight. You can learn more by calling his office at 888-346-7444 or visiting the website agaryschilling.com. So, Gary, the Fed's meeting here at the end of July, given all these leading indicators that have a pristine track record, do we see a surprise rate cut?
Well, right now the Fed is in no rush to do anything, and I think that's one thing that has become pretty widespread in terms of people's appreciation. You've got you don't have an economy that's rip-roaring. Inflation is above the Fed's target of 2%, but it isn't increasing. It's sort of stable at a higher rate, percentage point or more above that 2% target. It's sort of a situation where the Fed isn't doing much of anything, and I think just waiting to see what happens. So I just don't think this is a period when you have Fed leadership, and that's important because if you go back 2 years ago, the Fed was convinced that it had to do something about surging inflation. It was late to the party. Inflation got up to 9% year over year, and the Fed thought it was a very short-term phenomenon. They finally realized it wasn't, so they really jacked up interest rates tremendously from about 0 to close to double digits. The Fed was very much the leader. Right now, the Fed is not. I think the Fed is basically, I wouldn't say following the crowd, but doing nothing, waiting to see what transpires, and not feeling any particular pressure to raise rates or to lower rates. They obviously want to see inflation back toward their 2% target, but they're not tightening up the economy to get it there. And by the same token, they don't see things running away. So the Fed is kind of a neutral. And the leadership now is not with the Fed, it's with the economy. And that's a very different situation than what we had 2 years ago.
Gary, we've got just a couple minutes left in this segment. You mentioned or characterized the Fed's inaction, to use that term, as they're in neutral. Do you think any of that has to do with the fact that this is an election year and they want to, appear anyway to be nonpartisan?
Well, that's the supposition. And of course, the closer to the election you get, the less likely the Fed is to make any dramatic moves, because they do not want to appear that they are influencing the election. So I would say we're getting to the point now where, the first Tuesday in November, to pick a random date, is getting close enough that the Fed doesn't want to do anything precipitously. They could earlier in the year. Maybe they still could if they felt it was absolutely necessary. But as time marches on, they really want to stay in a neutral position.
Well, I am chatting today with Dr. A. Gary Schilling. He is the publisher of Insight. I'd encourage you to check it out. You can learn more about Insight by calling his office at 888-346-7444, or you can visit his website at agaryshilling.com. The good news is I'll be back for another 12 minutes with Dr. A. Gary Schilling after these words. Stay with us. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen. I have the pleasure of chatting today with Dr. A. Gary Schilling. He is the publisher of the newsletter Insight. If you've not checked it out, I'd encourage you to do that. As I mentioned in the first segment, Insight is really more of a magazine every month than it is a newsletter. You can learn more at his office, by calling his office, I should say, at 888-346-7444, or visit his website at agaryshilling.com. So, Gary, we've been talking about, at the end of the last segment, Fed policy, and certainly when you take a look at Fed policy over the past couple of years as interest rates have gone up, it seems to be affecting the real estate market. Let's maybe start by talking a little commercial real estate. A lot of commercial real estate loans that are coming up and have been coming up for refinancing at much higher interest rates. How do you see that impacting the commercial real estate market moving ahead?
Well, I think commercial real estate is the most vulnerable segment of the economy. Now, that doesn't mean that it's going to result in anything like the collapse we saw with subprime mortgages. It's not that widespread. It doesn't include everybody who's out to make a killing by borrowing virtually free. But it is a major issue because you've had a lot of commercial loans, and office buildings are in the worst shape. A lot of that, of course, because people have not returned to their offices. They've been working from home, huge vacancy rates, and the problem is, what do you do with those office buildings? They're not really suitable to convert to apartments. You look at a floor of an office building, it's pretty wide, window to window. It isn't like a house where maybe you got 50 feet maximum from one side to the other. So you have a lot of these office buildings where they really don't know what to do with them. There's no real demand, and of course they are suffering because a lot of them, the loans are coming due, and nobody wants to refinance them. Banks are very shy on this, so the office segment of commercial real estate is really the most vulnerable area, and it's not getting any better.
So, Gary, let's shift gears a moment here and talk residential real estate. Certainly, we've seen housing sales slow a bit, but prices have not been significantly impacted. Maybe down a little bit. You can correct me if I'm wrong, but what's your assessment of the current state of residential real estate housing and moving ahead? What do you see?
Well, residential is in a very interesting and unusual situation. What happened was back before the Fed raised interest rates, a lot of people got mortgages, 30-year fixed-rate mortgages at 3 or 4%. Now, what's happened subsequently with the Fed raising interest rates is those interest mortgage rates have essentially doubled. So nobody wants to sell their house and buy another one because they'd incur a huge increase in their monthly payments for the mortgage. So you have a very unusual situation of where a lot of people just are locked in to mortgages. They're paying low rates, but they have absolutely no incentive to do anything differently. So that means that there isn't much turnover in housing, and you have this odd situation of where the housing sector is really troubled, but yet there's no inventory. Nobody's selling houses because they're locked into these low-yield mortgages, and so it's a difficult situation for anybody who wants to buy a house, and consequently prices have jumped, and you would say, well, gee, under these circumstances, if you didn't have this limitations on turnover, you probably would have ample inventories, but you don't. So it's an odd situation, and it probably isn't going to change much in the near future because people are still locked into those 3 or 4% yields, and in a 30-year mortgage, these things don't turn over that fast. So you got a situation where the housing market is pretty much stuck, and it's a historically an odd situation, but one that's perfectly logical, but probably isn't going to change much in the foreseeable future.
I am chatting today with Dr. A. Gary Schilling. His website is agaryschilling.com, and if you'd like to learn more about his excellent newsletter, Insight, give his office a call at 888-346-7444. Gary, when you look at what happened around the time of the pandemic, there was a lot of stimulus that was distributed by the government. I think consumer savings, according to the San Francisco Fed, went to over $2 trillion. And over a relatively short period of time, consumers went through a lot of that, and then credit card debt started to build. Is this trend a sign that, you've got lower income and middle income households that are really struggling with inflation here?
Yeah, I think that's right, Dennis. You did, as you point out, you had 3 rounds of fiscal stimulus in reaction to the pandemic, and that did result in a huge increase in assets of households. Now, people have basically run through those, and the excess saving, the saving over and above the normal positions, is pretty well exhausted. And so, not surprisingly, people are resorting to borrowing on credit cards and auto loans and so on and so forth, and this is very expensive. So So you have a situation of where the excess saving is pretty much exhausted, and the borrowing is expensive, and at some point it's obviously got to curtail people's spending. Now, surprisingly, it hasn't so far. People apparently had plans to buy a new car or whatever, and they haven't given up yet. But it seems to me when you're looking at credit card rates of 20%, that does at some point discourage people from borrowing. So I think you do have a real restraint on the consumer. And of course, that's the kind of thing the Fed would like to see. They don't come out and say, "Oh, we want to see people squeezed so they can't afford to borrow," but they do want to see a slower growth in consumer spending, and with much of it now being financed with credit cards and other forms of borrowing, it's the effects of high interest rates working through the system, which are likely to bring about what they're looking for.
Gary, I read an article this past week, and I won't quote the source because I'm not exactly positive that I recall the source, but it said from one of the mainstream news sources that when it comes to student loans, there are estimates out there that about half of student loan borrowers are currently not making payments. What's your take on that? And isn't that just more evidence that the consumer is strapped if that is the case?
Yeah, I think that's true. A lot of people apparently felt that with student loans that they had no responsibility for paying the money back. The feeling of responsibility just wasn't there. So you have a lot of these loans which are not being serviced, and there are all kinds of excuses. And we don't have an administration now, the Biden administration, which is interested in collecting these loans. As a matter of fact, Biden had a plan to forgive a lot of loans, which was shot down by the Supreme Court, you might recall. So you do have a situation now where there's a lot of student debt there. Now we'll see what happens with the election and whether there's a clampdown on this. But at the moment, you've got a tremendous amount of student debt, which is simply not being serviced. And the idea of will there be a moratorium, will there be forgiveness? I think that depends an awful lot on the politicians in Congress. But it is creating potentially a serious problem.
Well, Gary, in the time we have left, I don't have really enough time to devote to this, but I'd love to get your opinion. U.S. government this year probably will operate with about a $2.3, $2.4 trillion deficit. There was a report out, official report, that the Social Security Trust Fund will be officially out of money by 2033 using what I thought were relatively optimistic assumptions. How long can all this underfunding and deficit spending go on before we finally get to the point where the proverbial rubber meets the road, in your view?
Well, we've done a fair amount of research on that, and we've never been to the point that we've had so much debt that it has killed the financial markets. Now, they've had that in countries like Argentina, but we've never had it. But we've looked at the numbers, and we've looked at it in terms of interest on the debt. And when does that get to the point where the interest on the debt, which is part of the deficit, the annual deficit, where that simply adds to the debt in a geometric pattern and gets to the point that the thing explodes? And we're getting to that level. So it really could be in the next few years. It could be a very serious problem because unless there's a decided change in the attitude toward deficits, they're going to be adding to the debt, and the interest on that, and interest rates, of course, have risen dramatically in the last couple of years. That really creates further strains, and I think we are at the point now. Now, nobody tells you exactly when you get to the point where the whole thing collapses. But we're getting into ground we've never traversed before, and I think that the risk is increasing.
So, Gary, I'm going to run just a little bit over here, but when we get to the point that this does implode, assuming we get there, what does that look like for the average American out there that's trying to sock away some money in an IRA and a 401k? What does the world look like at that point?
Well, it could look pretty chaotic, because you could have a big jump in interest rates and make it very difficult for people to afford to borrow, and you could have real restraints on borrowing. So I think it could result in some real strains, particularly on people who have been borrowing. And that's one of the things we've seen in the last couple of years with a jump in interest rates from virtually zero to where they are today, is that a lot of people were used to paying virtually nothing to borrow, and suddenly it's getting expensive. And that's a real strain, and it could be magnified from here. So I think there could be some very serious restraints.
Well, the clock says we're going to have to leave it there. My guest today has been Dr. A. Gary Schilling. I would encourage you to check out his newsletter. You can learn more by calling his office, 888-346-7444. Let them know you'd like to learn about the Insight newsletter. You can also visit agaryschilling.com. Gary, always a pleasure to catch up with you. I get terrific feedback when you're on the program. Thank you for joining us today.
No, it's my pleasure as usual, Dennis, and look forward to doing it again soon.
We will certainly do that. We will return after these words. Welcome back to RLA Radio. I'm your host, Dennis Tubbergen, and thanks again to my special guest, Dr. A. Gary Schilling, for joining me on today's program. Hey, if you're just tuning in, I have a brand new special report I'm offering today. It is titled Tax-Free Retirement Income Strategies. If you aspire to a comfortable, stress-free retirement, if you are already retired, given the fact that the current lower tax rates sunset January 1, 2026, if nothing changes, this report is especially timely. Again, the report is titled Tax-Free Retirement Income Strategies, and I'd be glad to send you a complimentary copy. All you need to do is go to requestyourreport.com. Give me your name, give me your mailing address. I'll drop it in the mail to you. There's no cost for the report. There's no obligation to do anything. It is just another perspective and another resource for you. So again, requestyourreport.com is the site. So what about this notion? What about the opinion of many of these economic prognosticators who say that we are going to have a soft economic landing? Well, I would argue the contrary. I would argue that a perfect financial storm is building. Now, maybe some of you who are old enough remember the book and then the subsequent movie that had that title. The book was a nonfiction work based on the Andrea Gale fishing boat that got caught more than 500 miles from shore in 1991 while sword fishing. And this perfect storm was created when all the variables required to create an incredibly devastating storm lined up at precisely the right time and in the exact correct order. Now, I believe that perfect storm analogy with all the variables lining up perfectly is exactly what might be going on now in the economy, in the financial markets, and certainly with the events over the past couple of weeks in the political climate as well. Now, in this segment, I don't really have time to talk about politics. I don't have time to talk about the financial markets. I really did that in the first segment of today's program. Let's just take a minute and look at debt. Let's look at government debt. And the phrase that best describes government debt is simply out of control. The national debt of the United States right now stands at about $35 trillion. Now, we throw these numbers around, trillions of dollars, like we understand exactly what it means, but a trillion is a really tough number to get your arms around. So let me attempt in this segment to put it in perspective for you. According to the National Debt Clock, to fully retire the debt, every American citizen would have to write a check for $103,565. That's every man, woman, and child in the United States. But we all know not every American is in a position or even close to being in a position to be able to write a check for that amount. So for discussion's sake in today's segment, let's narrow that math down to include only American taxpayers in the calculation. We'll exclude all Americans who do not pay income taxes. If we take the national debt and we spread it out evenly over all U.S. taxpayers, each taxpayer would be writing a check for $266,953 to wipe out the debt. Now, the $35 trillion national debt that the United States has is more than the total economic output of China, Japan, Germany, and the UK combined. To put the $1 trillion number in perspective, if you spent $1 million every day since the birth of Christ, you would have not yet spent $1 trillion. 1 trillion seconds is about 32,000 years. Now, if you take those rather mind-boggling examples and multiply by 35, you begin to understand the magnitude of the national debt problem. But it doesn't end there. Social Security and Medicare are woefully underfunded, according to a recent report by the U.S. Treasury I talked about here on this program. The Social Security and Medicare programs are underfunded by $173 trillion. So let's take $173 trillion, add the U.S. government debt of $35 trillion to it, and we're at about $208 trillion. And we still haven't talked about the unfunded liabilities of other government programs, including Medicaid. I've seen estimates the total U.S. fiscal gap is now more than $250 trillion. And if we take 100% of the assets that exist with households and nonprofits and in non-financial corporations, we get about $221 trillion. So we can confiscate 100% of private sector debt, and we still don't solve the problem. That's why I believe that we will ultimately see a very painful deflationary environment. And that's why I would urge you to educate yourself. In the near future, I believe we will not see business as usual. And when you request this month's report, Tax-Free Retirement Income Strategies, I'll also send you a copy of my revenue sourcing book that contains retirement planning strategies for the new economy. And again, to get the report and all the bonus information, just visit requestyourreport.com. Again, the website, requestyourreport.com. That's all the time I have for this week. Glad you decided to listen in, and I'll be back again next week. Have a great week.